really a once-in-a-lifetime opportunity to load up on high-quality companies because the market is not discriminating, we think, well enough between high quality and low quality. Typically, high-quality companies sell at huge premiums to the market. The problem is these companies at one point did. They sold 25, 30 times market multiple. Walmart, Microsoft, ADP, there's Home Depot. There's a long list of them. Over the last 10 years, those multiples have compressed by 50%. They've gone from 25 times to 11, 12, 10 times. And so these are high quality companies. The market got disenchanted. These companies were cursed with known as the curse of high expectations. High multiples equals high expectations. They actually delivered fundamentally pretty good. The problem is they didn't deliver enough relative to those expectations, and the market multiples compressed on them. So we've been loading up on a lot of companies that we consider high quality, diversified, a lot of foreign exposure, wide moat companies with competitive advantages. Our bet here is that the discount between low quality and high quality will converge, and we'll make money that way. The cyclicals, we're always looking to add cyclicals at the margin, especially in the late cycle today. And so we found some opportunities there. Not wanting to pay up for obviously good performance, but always looking because the cycle does look like it's picking up steam. Manufacturing is very strong worldwide. You've probably seen in earnings recently from Honeywell, UTX, Ranger, and others. So there's a resurgence there going on. We're looking for ways to play that. Dirt cheap companies, we always love dirt cheap, statistically cheap companies where the market doesn't believe the cash flows are sustainable. And so we're taking a variant view relative to the market. Companies like Lockheed Martin, Time Warner Cable, United Healthcare fit that description. International foreign stocks, we can own about 20% in our prospectus of ADRs, foreign ADRs, as well as ordinaries, and we're up at that limit right now. We find a lot of value internationally. We find most of these stocks are traded at discounts to the U.S. market and have as good, if not better, prospects. So we are often mining. We analyze industries on a worldwide basis, so we're always looking at these companies and buy them frequently. And you see examples there, Jardine Matheson, which is an Asian play, conglomerate in Asia and based in Hong Kong, of Scottish descent, maybe some of you have heard of it. But like companies like Royal Dutch Shell, Diageo, Nestle, Siemens, and recently bought Daimler as well. Restructuring stories we always like. We love companies that are uncorrelated with the market and mostly correlated just with themselves and their own problems. You can diversify your portfolio a little bit from the market tendencies when these companies are really under a cloud. So we're always looking for opportunities where they can gain control of their own destiny, fix their operations through blocking and tackling and repositioning their assets for better use. Companies like that include Schindler, Carrefour, which is in France, Texas Instruments, CIT, and some others. And finally, M&A. We think M&A is going to be a big theme. It has been and will continue to be. The reason is there's too much capacity, and we don't have enough growth to soak it up. So we need to consolidate industries, whether it's retail, financial services, housing, and that's happening. That's a good, healthy, cathartic thing. That's what's occurring today. But we need it to happen at a faster rate because we need to rationalize industry and improve the economics of the incumbent players. So we think you'll benefit not only from targets getting acquired, which you usually benefit because you get a premium, but even the incumbents will do well because they're going to get a step change in their earnings power by buying assets on the cheap. Most companies are not paying big multiples for the consolidation opportunities that are appropriate. So that's it on the formal presentation. I know we're out of time. We're very close to it. I have some examples of some stocks that we own, that like, and have owned for some time, that are controversial. Most of them are cheap. They're unloved. They're undervalued, they're misperceived, and that's where we dig. Microsoft's one of them. We can talk about that if you have a question. I can provide this handout to you too if you guys are interested. We can manage to get this to you. So I'll give you just some examples here. Microsoft is one. It's a good example too because it's been a frustrating stock. It hasn't really worked for us, and we're still sticking with it. We think there's value there. 10 times PE, 10% free cash flow yield, generates $22 billion in free cash a year. The misperceptions are going to miss this next tech cycle. Meanwhile, there's a cyclical improvement in PCs and in servers, and they're well positioned for the cloud, which most people don't have a good appreciation for. They're winning business. They're a leading mind share among CIOs, and through their SharePoint, through all sorts of technologies they're bringing to bear. It's also misperceived because people think that they're a bad capital allocator because they've lost money on certain things like Bing or their phone or some other things. And that's true. We did an analysis. We looked back how much money they've wasted over the last 10 years on this kind of issue that the market is so hung up on. We found out about $20 billion in cumulative losses trying to diversify into other areas. Sounds like a lot of money. Sounds like they're destroying shareholder value, right? That's part of the business of growing technology. They're going to spend money to try to advance and innovate. When you juxtapose that against what they've returned to shareholders the last 10 years, it's dwarfed in comparison. They've returned $100 billion to shareholders in the form of a special dividend, an ongoing dividend, and buybacks. So $100 billion versus $20 billion. And then all that $20 billion is a loss. Part of it is the Xbox, which has been a huge winner for them. Part of it is the Kinect device. You probably are familiar with that. That is the fastest growing, one of the fastest growing products of all time. They sold 8 million of these things. They are innovating. There is a misperception. They could have done better. They've made mistakes. They've destroyed some value here and there. But we don't think the company's dead yet. We like this cycle. I'll be quick here. Other companies, this is just a bona fide cheap stock. Time Warner Cable throws off a lot of cash flow. People are concerned about over-the-top risk with technology and the internet. We think it's overstated. We think they have a durable, strong business and a competitive advantage. And their broadband business has extreme pricing power. And even if it does go over the top, if all the video subscriptions go away, guess what? They're going to charge you 10x more for your broadband subscription, probably to compensate for this, because they're probably the only game in town. We bought Daimler recently. This is a late cyclical. It's trading at 3.5 times EV to EBITDA cash flow. It's cheap, and we like the truck cycle, the number one truck player. We think the truck cycle is inflecting right now. We also love the car cycle, because not only is the developed countries, rebounding to more of a steady state. They're about running about 13 million SAR right now, cars. We think it's going to 15 million. China in 5-10 years is going to be at, 25, 30 million cars. And luxury is actually outgrowing the normal market. So this is a huge market for them, and they're well positioned. And I'm running out of time. I'll flip through some others. Carrefour is a French grocery store, supermarket, hypermarket, competes with Walmart. It is an ugly duckling. You look at that chart for 10 years, you wouldn't want to buy this stock. But changes are occurring slowly. We think they're going to unlock value. They're going to shrink to grow. I should open this up for Q&A right now. I could go through more stocks if you want to. You tell me, it's your time. What direction would you like to go in? Any questions that you'd like to talk about? Yes?
I'd like to hear your opinion about Coca-Cola and Intel.
Coca-Cola and Intel. We don't own Coca-Cola. We do own Intel.
Yeah, I know you do own Intel.
Coca-Cola is a great company. I love Coca-Cola.
So you don't put it as a blue chip because you don't think it's cheap enough.
That's right. Great company, great business. Just not cheap enough for us. We're discount shoppers, and it's priced at a premium to the market. And as I mentioned, we generally don't buy things at a premium to the market. So if it ever got to at market or below market, we'd be looking at it. It's a great company. We follow it. I'm interested. I've looked at Pepsi too. It's a little cheaper. We passed on that one too. We used to own Cadbury Schweppes, which is owned Dr. Pepper Snapple, so we had exposure to the area before. We thought they would break up that company, which they ended up doing. And we still owned Cadbury through Kraft, which acquired Cadbury. And we like that company as well, long term. So we still have exposure, but it's just a little rich for our taste. Intel is just like Microsoft. It's the same kind of situation. It's trading at 9, 8, 9, 10s. Had great earnings, by the way. Anybody noticed. The markets sure finally paid attention and drove the stock price higher. Great dividend yield, throws a lot of cash. Competitive advantage in manufacturing, second to none. We don't think they're dead. The market's assigning them essentially no terminal multiple. They're saying they're never going to be around at the end of 10 years. We're willing to take that bet. We think they will be. And we think they're going to be successful in getting into new technologies, because it's kind of like Microsoft. Microsoft, with their balance sheet and their cash flow, they can play catch up. They're fast followers sometimes. And Microsoft has never been really good at innovating in and of itself, but they're very quick at coming up from the rear and squashing the competition subsequent. But they are innovating too, and we like Intel. Yes.